Breaking. The cheap silver period is over. Here's why. U.S. price floor incoming. Reuters has just confirmed it. The United States government is establishing a price floor system for critical minerals. Silver is on that list. 50 nations are already coordinating. But here's what most people don't understand. This isn't about protecting investors. It's about protecting something far more critical. When governments stop allowing free markets to set prices, when they draw a line and say prices cannot fall below this point, they're not reacting to market conditions. They're preparing for what's coming next. 2 days ago, silver hit $90, then crashed to $83 in under 3 hours. The same pattern, twice, during the exact same trading session, while Shanghai prices remain 19% higher. The question isn't whether the market is breaking. The question is, who knows what's happening and who doesn't? Welcome to Financial Crisis Explained. If you've been in business long enough to remember when a handshake meant something, when contracts were honored without lawyers standing by, then you understand that real information, the kind that matters, doesn't come wrapped in hype. We don't do that here. What we do is simple. We analyze the data that institutions watch. We connect the policy decisions that reshape markets, and we deliver it without the noise. Now, if that sounds like something worth 30 minutes of your time each week, do me a favor. Hit that subscribe button. Not because I'm asking you to join some community, but because this information, these structural shifts, they don't announce themselves twice. And one more thing, drop a comment below and tell me where you're watching this from. Are you in North America, Europe, Asia, the Middle East? I want to know who's paying attention to this and where you're positioned when these changes hit, because geography matters when supply chains restructure. Now, let's get into what's really happening. On a Wednesday morning in Washington, a policy announcement cut through the noise of routine government business. U.S. Vice President J.D. Vance stood before representatives from more than 50 countries and confirmed what very few people expected. The United States will establish a price floor system for critical minerals, and silver is included in that system. For those who understand what a price floor actually means, this was not just another policy statement. It was a structural market reset. A price floor is not a suggestion or a recommendation. It is a line drawn in the sand by a government that says prices will not fall below this level. When free markets set prices, supply and demand determine value. When governments set price floors, they are overriding that mechanism. They are saying the market cannot be trusted to maintain the price necessary for national interests. This is not market manipulation in the traditional sense. It is strategic resource protection. And it signals something far more significant than most people realize. Historically, when governments establish price floors for commodities, they do so because they have identified a critical vulnerability. Agricultural price supports in the 20th century were not about helping farmers make money. They were about ensuring food security and ensuring that domestic production capacity did not collapse during price downturns. Once production capacity is lost, it takes years to rebuild, and in times of crisis, those years matter. The same logic applies here. Silver has been classified as a critical mineral by the United States government, not because it is expensive, but because it's essential. Essential for defense systems, electronics manufacturing, solar energy infrastructure, and the technologies that define modern industrial capacity. Most analysts are missing the critical point that 50 nations participated in this meeting. 50 nations are now coordinating on a framework that acknowledges market prices alone cannot guarantee supply security. This is not one country acting in isolation. This is coordinated international policy, which means the vulnerability is not theoretical. It is recognized at the highest levels of strategic planning across multiple governments. The United States does not have a strategic silver reserve. Unlike oil or certain rare earth elements, there is no government stockpile to buffer against supply disruptions. China, by contrast, has been systematically accumulating silver for years and controls the majority of global silver refining capacity. China dominates the processing infrastructure that turns mined silver into usable industrial material. The dependency ratios are stark, and they represent a national security concern that goes beyond economics. When a country realizes it cannot produce the materials necessary for its own defense and industrial base, and when those materials are controlled by geopolitical competitors, policy changes. The price floor system is that policy change in action. But there is another layer to this announcement that requires attention. Price floors are not implemented overnight. They require mechanisms, funding structures, and coordination frameworks. The government must either commit to purchasing silver at the floor price, establish strategic reserves, or provide production subsidies that keep marginal mines operational even when market prices fall. Each of these mechanisms has different implications for how quickly the market reprices and how effectively the policy achieves its objectives. What makes this announcement particularly significant is its timing. Global silver markets have been experiencing extreme volatility. Prices have surged toward $90 per ounce, only to collapse back to $83 within hours. This pattern has repeated across multiple trading sessions, suggesting that the current market structure is under stress. The announcement of a price floor system arrives precisely when price discovery mechanisms appear to be breaking down. The question facing business leaders and investors is not whether this policy represents a meaningful shift. The question is whether the market has already priced in this structural change, or whether a repricing event is still ahead. When governments signal that they will not allow prices to fall below a certain level, they are effectively removing downside risk for producers and creating a new baseline for long-term planning. Mining companies can make capital allocation decisions with greater confidence. Industrial users must reassess their hedging strategies. Investors must recalibrate their risk models. This policy does not exist in isolation. It represents a calculated response to global supply chain realities that have been building for years. The era of unrestricted globalization, where supply chains stretched across continents with little regard for geopolitical risk, is ending. The era of strategic resource security, where governments actively manage access to critical materials, is beginning. The silver price floor is one visible manifestation of that transition. The question is not whether this changes the market, but how quickly the market reprices to reflect this new reality. Something strange has been happening in the silver market, and most traders are missing it entirely. For 2 consecutive days, the exact same sequence of events unfolded with precision that defies coincidence. Silver prices climbed steadily through Asian trading hours, continued rising through European sessions, and then collapsed violently during New York trading hours, not just once, but twice in 48 hours, following the identical script. On the first day, silver reached $90 per ounce. Within 3 hours of the New York session opening, it had fallen to $83. That represents an 8 to 9% decline in less than one trading session. The next day, the pattern repeated itself with remarkable accuracy. Rally overnight, reached $90, then collapsed back to $83 during U.S. trading hours. This is not normal market behavior. This is not random volatility. This is a pattern, and patterns in financial markets always tell a story. The question is whether anyone is listening. The technical data reveals something even more troubling. Silver has attempted to break through the $90 level multiple times and has been rejected each time. There has not been a single daily close above $90 despite multiple intraday attempts. The 150-day exponential moving average on the hourly chart sits at $96 to $97, representing another layer of technical resistance approximately $10 to $11 above current levels. But technical resistance alone does not explain the violence of these reversals. Gold experienced a similar pattern during the same time frame, falling $220 per ounce in under 3 hours. When both precious metals experience simultaneous sharp reversals during the same trading session, it suggests coordinated selling pressure, not organic market activity. The geographic dimension of this pattern is particularly revealing. During Asian hours, when physical markets in China, India, and Southeast Asia are active, prices rise. During European hours, when London trading desks are operational, prices continue climbing. Then New York opens, and systematic selling pressure appears like clockwork. The derivative markets, where paper contracts trade without physical metal changing hands, become the dominant force and prices reverse. Shanghai pricing tells a completely different story. While Western spot prices hover around $86, Shanghai spot prices are trading at $102. Shanghai futures are at $101. That represents a $16 premium, or 19% above Western prices. A 19% geographic premium is not a minor arbitrage opportunity. It is a structural dislocation that signals something fundamentally broken in the global price discovery mechanism. When physical buyers in Asia are willing to pay 19% more than paper prices in New York, they are sending a clear message. They do not trust paper markets to deliver physical metal at stated prices. They are paying a premium for guaranteed physical delivery because they understand that contract settlement and physical possession are two very different things. Volume analysis during these reversal periods shows massive selling pressure concentrated in derivative contracts. Futures positions, options contracts, and exchange-traded products all experienced heavy selling during New York hours. Meanwhile, reports from physical dealers indicate continued strong demand for coins, bars, and industrial quantities of physical silver. Buyers are accumulating, yet prices are falling. Sellers are dumping paper contracts, yet physical premiums are rising. This divergence between physical and paper markets has historical precedent. In previous commodity cycles, when paper markets and physical markets decouple, the resolution always favors physical reality. Paper contracts can be created infinitely. Physical metal cannot. When the gap becomes too wide, either paper prices must rise to reflect physical scarcity, or physical delivery failures occur and the paper market loses credibility entirely. The speed of these reversals is also significant. A 9% decline in 3 hours is not gradual profit taking. It is not long-term investors adjusting positions. It is algorithmic selling, coordinated institutional selling, or forced liquidation of leveraged positions. The velocity suggests urgency, and urgency in markets typically indicates either panic or deliberate price management. What makes this pattern even more significant is its persistence despite the policy announcement from Washington. Normally, when a government announces a price floor system, markets would begin pricing in that support level immediately. Instead, prices continue to experience violent downward pressure during specific trading hours. Either the market does not believe the policy will be implemented, or certain participants have reasons to suppress prices before implementation occurs. For business leaders trying to understand what this means, the pattern reveals a market in transition. The old price discovery mechanism, where paper derivatives dominated physical fundamentals, is breaking down. The new mechanism, where government policy and physical scarcity reassert control, has not yet fully emerged. In that transition period, volatility is not just likely, it is inevitable. The $90 level has become a psychological and technical battleground. Those attempting to push prices higher are meeting organized resistance at that level. Those defending lower prices are deploying massive selling pressure during New York hours. This is not a market finding equilibrium. This is a market where two opposing forces are engaged in open conflict, and one side will eventually capitulate. The question is, which side breaks first, and what happens to prices when they do? There's a fundamental problem in the silver market that most people refuse to acknowledge. The numbers do not work anymore, and pretending they do will not change the underlying reality. Mining silver from the ground is expensive. Drilling costs money. Equipment costs money. Labor costs money. Energy costs money. Environmental compliance costs money. Refining costs money. Transportation costs money. Every ounce of silver that reaches the market carries the weight of these costs. And when market prices fall below those costs, miners face a simple choice: continue operating at a loss or shut down production. The global average all-in sustaining cost for primary silver production sits between $22 and $26 per ounce depending on the region and mine characteristics. Primary silver mines are operations where silver is the main product being extracted. These mines are directly sensitive to silver prices. When prices rise, production becomes more profitable. When prices fall below production costs, these mines become economically unviable. But most silver does not come from primary silver mines. Approximately 70% of global silver production comes as a byproduct of mining other metals like copper, lead, and zinc. Byproduct silver means the mine is primarily extracting another metal, and silver is recovered as a secondary output during the refining process. This creates a pricing dynamic that most analysts misunderstand. Byproduct silver supply is price inelastic. Even if silver prices fall dramatically, copper mines will continue operating because they are profitable based on copper prices. The silver they produce as a byproduct will continue flowing into the market regardless of silver's price. This creates a supply floor that prevents total production collapse, but also means that price signals do not reduce supply as effectively as they would in a market where all production is price sensitive. However, the 30% of supply that does come from primary silver mines is absolutely critical. When primary mine production becomes unprofitable and operations begin shutting down, the market loses its marginal supply. And marginal supply is what determines price at the edges of the supply-demand balance. If industrial demand remains constant or grows in primary mine supply contracts, the math leads to only one outcome: higher prices or supply shortages. Current market prices in the $80 to $90 range are well above the average production cost, which should theoretically support continued production. But averages hide the distribution. Some mines operate at costs below $15 per ounce due to high-grade deposits and favorable conditions. Other mines operate at costs exceeding $35 per ounce due to lower grades, deeper deposits, or challenging geography. The cost curve is not flat, and as prices fluctuate, different segments of the cost curve become marginal. The real problem emerges when looking at future supply, not current supply. Discovering a new silver deposit and bringing it into production takes 7 to 10 years on average. Exploration requires capital. Drilling and resource definition require capital. Environmental studies and permitting require time and capital. Mine construction requires massive capital. This timeline cannot be compressed significantly regardless of how much money is spent. The current project pipeline for new silver mines is alarmingly thin. Major discoveries have declined over the past 2 decades. Existing mines are experiencing declining ore grades, meaning each ton of rock processed yields less silver than it did 10 years ago. Energy costs have risen substantially, increasing the cost of extraction. Regulatory environments in key mining jurisdictions have become more complex and time-consuming. All of this creates a future supply problem that cannot be solved quickly, even if prices rise substantially today. If industrial demand continues growing, particularly from solar panel manufacturing and electronics production, and if investment demand increases due to monetary concerns or geopolitical uncertainty, the available supply may not be adequate to meet that demand at current prices. Geography adds another layer of complexity to this equation. The top 5 silver-producing countries are Mexico, Peru, China, Australia, and Chile. Together, these nations account for more than 60% of global mine production. Political stability, regulatory changes, labor disputes, and resource nationalism in any of these countries can disrupt supply significantly. Mexico, the world's largest silver producer, has experienced regulatory changes that have created uncertainty for mining operations. Peru has faced social conflicts between mining companies and local communities that have delayed or halted production at several operations. China controls not just production, but also refining capacity, giving it strategic leverage over global supply chains. Any disruption in these key producing regions would immediately tighten physical markets. Industrial demand for silver is fundamentally different from investment demand. Investment demand is price elastic. When prices rise, investors may sell. When prices fall, investors may buy. But industrial demand is price inelastic in the short term. A solar panel manufacturer cannot easily substitute another material for silver in photovoltaic cells. An electronics manufacturer cannot redesign circuit boards overnight to eliminate silver usage. Industrial users must purchase silver at prevailing prices, regardless of whether they think those prices are high. Solar energy deployment is accelerating globally. Each solar panel requires approximately 20 grams of silver. As solar capacity expands to meet climate goals and energy security objectives, silver demand from this sector alone is projected to increase by double-digit percentages annually. Electronics manufacturing, 5G infrastructure build-out, and emerging technologies like electric vehicles all add incremental industrial demand. Strategic stockpiling by governments and large industrial consumers is another variable that could rapidly tighten markets. If major economies or corporations decide to build inventory buffers against supply disruption risks, that demand would hit markets that are already operating with relatively tight physical inventories. Unlike oil, where strategic petroleum reserves exist in many countries, silver has no comparable government stockpile system in most Western nations. China has been systematically accumulating silver for years, through both government and private channels. While exact figures are not publicly disclosed, import data and refining capacity utilization suggest substantial quantities have been absorbed into Chinese reserves. This accumulation has occurred quietly over time, but it represents supply removed from global markets that will not return easily. The price floor policy announcement must be understood against this supply backdrop. If governments recognize that market prices alone will not maintain adequate production capacity, and if they implement mechanisms to support prices above certain levels, they are acknowledging that the cost structure of production has become incompatible with maintaining strategic supply security at market-determined prices. For businesses dependent on silver inputs, this creates a planning problem. Hedging strategies that assume mean reversion to historical price ranges may no longer be valid if the structural cost floor has shifted higher. For mining companies, capital allocation decisions must account for a potentially more stable price environment with government support. For investors, the traditional cyclical patterns of commodity markets may not apply when strategic policy intervention becomes a permanent feature of price formation. The math is straightforward. Production costs are rising. Future supply growth is limited, industrial demand is growing, strategic stockpiling is increasing, and now government policy is establishing price floors to prevent market prices from falling below levels necessary to maintain production. These variables do not point toward lower prices over time. They point toward a repricing that reflects physical reality rather than paper market dynamics. The announcement has been made. The pattern has been identified. The cost structure has been analyzed. Now the critical question emerges. What actually happens when policy meets market reality? Price floor systems do not implement themselves. They require mechanisms, funding, and enforcement structures that transform abstract policy into concrete market impact. The United States government has multiple options for how it establishes and maintains a price floor for silver, and each option carries different implications for how quickly markets adjust and who benefits from that adjustment. The most direct mechanism is government purchasing. If silver prices fall below the established floor, the government commits to buying silver at that floor price. This creates immediate demand support and sends a clear signal to producers that a minimum price is guaranteed. The challenge with this approach is that it requires either budget appropriations or the establishment of a strategic reserve system with dedicated funding. Building a strategic silver reserve from zero would require substantial capital and storage infrastructure. Another mechanism is production subsidies. Rather than buying silver directly, the government provides financial support to mining operations when market prices fall below production costs. This keeps marginal mines operational and maintains domestic production capacity without requiring the government to hold physical inventory. The drawback is that subsidies can be politically contentious and may face challenges in budget negotiations or changes in political administrations. A third option is tariffs or import restrictions that effectively raise the domestic price floor by limiting foreign supply. If imported silver faces tariffs that bring its cost above the desired floor price, domestic producers benefit from higher effective prices, even if global market prices remain lower. This approach protects domestic production, but risks retaliation from trading partners and could strain international relationships. The most likely scenario is a combination of these mechanisms, tailored to balance effectiveness, cost, and political feasibility. What matters for market participants is not the specific mechanism chosen, but the credibility of the commitment. If markets believe the government will actually enforce the price floor, behavior changes immediately. If markets doubt the commitment or question the implementation timeline, the current volatility could persist. Historical precedent offers guidance on how commodity price floors typically play out. Agricultural price support programs in the mid-20th century took years to fully implement, but fundamentally changed how farmers made production decisions. Once producers believed the government would prevent prices from collapsing below certain levels, investment in production capacity increased because downside risk had been removed. The same dynamic could emerge in silver mining if the price floor proves credible. The timeline for implementation is a critical unknown. Policy announcements and actual policy execution can be separated by months or even years. Environmental reviews, legislative appropriations, international coordination with the 50 participating nations, and bureaucratic processes all create lag between announcement and impact. During this lag period, markets may continue exhibiting the volatile patterns observed over recent trading sessions. For businesses with silver exposure, the strategic implications depend on their position in the supply chain. Manufacturing companies that use silver as an input face a changed risk profile. If price floors prevent silver from falling below certain levels, the downside hedging strategies that protect it against price spikes become less valuable, but the upside risk of sustained higher prices becomes more significant. Procurement strategies may need to shift from just-in-time purchasing to strategic inventory building. Mining companies face a more favorable environment if the price floor is set at a level that covers their production costs with a reasonable margin. Access to capital should improve as lenders gain confidence that revenue floors are guaranteed by government policy. Marginal projects that were previously uneconomic may become viable if long-term price stability at higher levels is credible. Share valuations in the mining sector could reprice significantly if markets believe earnings floors have been established. For investors, the repricing scenario depends heavily on current market positioning. If large institutional investors or hedge funds hold significant short positions in silver derivatives, expecting prices to fall or remain range-bound, the establishment of a credible price floor could force rapid covering of those positions. Short covering in commodity markets can create explosive upward price moves as sellers rush to buy back contracts to close positions before losses escalate. Conversely, if the market has already priced in the expectation of government support, the announcement may have limited additional impact. The challenge with this interpretation is that current price action does not suggest the market has fully priced in a floor. The violent reversals and continued testing of lower price levels indicate ongoing uncertainty about whether support will materialize and at what level. The Shanghai premium remains a critical indicator to monitor. As long as physical buyers in Asia are paying 19% above Western paper prices, the market is signaling that physical scarcity exists despite paper market prices. If the premium narrows toward zero, it suggests physical supply has loosened or paper prices have risen to meet physical reality. If the premium widens beyond 20%, it suggests the dislocation is worsening and physical delivery stress may be increasing. The pattern of overnight rallies followed by New York session selling cannot continue indefinitely. Either the sellers exhaust their positions and prices break higher, or physical buyers exhaust their capital and prices break lower. Given the policy backdrop of a price floor system being implemented, the probability distribution favors an upward resolution, but timing remains uncertain. Risk management requires scenario planning across multiple outcomes. The base case assumes gradual implementation of the price floor over 6 to 12 months, with prices slowly adjusting higher as credibility builds. The bull case assumes rapid implementation combined with short covering in derivative markets, creating a sharp repricing event within weeks or months. The bear case assumes implementation delays, political challenges, or international coordination failures that leave current market dynamics unchanged for an extended period. Business leaders making decisions today cannot wait for perfect clarity because by the time implementation details are finalized, market prices will have already adjusted. The choice is between positioning for structural change now while uncertainty remains high, or waiting for confirmation and accepting that early positioning opportunities will have passed. The broader context cannot be ignored. This policy does not exist in isolation. It is part of a larger shift toward industrial policy, strategic resource management, and the recognition that unfettered globalization created vulnerabilities that national security concerns now require addressing. Rare earth elements, lithium, cobalt, and other critical minerals are all receiving similar policy attention across multiple governments. The era of treating commodities purely as financial assets traded on price momentum is colliding with the era of treating commodities as strategic resources requiring government oversight. Silver sits at the intersection of these two eras. It is both a monetary metal with investment demand and an industrial material with strategic applications. The price floor policy reflects the industrial strategic dimension, taking precedence over pure market dynamics. What comes next will be determined by implementation speed, market positioning, and physical supply-demand balance. The announcement has been made. The direction has been established. The question is not whether the era of cheap silver is ending. The question is whether market participants recognize this reality before prices force recognition upon them. The data is clear. The policy framework is clear. The supply constraints are clear. The only remaining variable is time, and in markets, timing determines whether participants profit from change or are caught unprepared when change arrives. The period of cheap silver, driven by paper market dynamics disconnected from physical realities and strategic policy considerations, is reaching its structural endpoint. What comes next will depend on execution, but the direction has been set. Those who understand this are repositioning. Those who do not will be repriced by market forces they did not see coming. The window for strategic adjustment remains open, but it will not remain open indefinitely.